Today we will be going through the balance sheet. The balance sheet is a financial statement. It lists the business assets, liabilities, and equity at a point in time. The balance sheet makes use of the principle of the accounting equation. Can you recall it? It is assets equal liabilities plus equity. This means the balance sheet has two sections, the assets section and the equity plus liabilities section. Note that there are also subsections of the balance sheet which I will explain now. Assets can be classified as non-current and current. Non-current assets provide benefits to the business for a long period of time, more than one accounting period. It cannot be easily changed to cash. It is used by the business to help in the day-to-day operations. Current assets are expected to be used up within one accounting period. It can be easily changed into cash. For example, current assets like inventory is meant to be resold to earn income. Liabilities can also be classified as non-current and current, where non-current liabilities must be paid beyond one accounting period. Current liabilities must be paid within one accounting period. Financial Reporting Standard 1, paragraph 54 require the following items to be presented in the balance sheet. For assets, it would be property, plant and equipment, investments, inventories, trade and other receivables, cash and cash equivalent, deferred tax asset, and other assets not covered. Liabilities to be presented include trade and other payables, provisions, current tax liability, deferred tax liability, and other liabilities not otherwise mentioned. Finally, the equity section needs to show the non-controlling interest, issued capital, reserves, and retained profits. I understand that some of these terms may be alien to you. Not to worry, we will cover this in greater details in future videos. Please leave out any items from the balance sheet if the item is not applicable in the context. Here's how a balance sheet may look like. Again, don't worry if you see any foreign terms. As mentioned earlier, a balance sheet has two parts, an assets part and a liabilities plus equity part. It relies on the principle of the accounting equation, so the total assets must equal total liabilities plus equity. Please note that the assets and liabilities need to be classified into current and non-current, and the threshold that distinguishes them is 1 year. I want to point out something as well. In the balance sheet, we have our assets, liabilities, and capital account. What about the income and expenses? Income and expenses do not appear in the balance sheet. It appears in the income statement. The balance sheet will only show the accumulated profit, retained profit, or retained earnings, which is the difference between the cumulative income and cumulative expense. When I say cumulative, it means from the first day of the business until the end of the current financial period. You can also calculate retained profits by summing up the net profit from the first day of business until the last day of the current financial period. So now, I'll give you some time to familiarize yourself with the format of a balance sheet before I show you an example of a company's balance sheet. Now let's take a look at an example of a company's balance sheet. So now I am at SBS Transit's financial statements, and SBS Transit is a public bus company as well as a train operator. So now let's see, where is the balance sheet? Here? Okay. Take note the balance sheet is sometimes called the statement of financial position. Let me see it because I think it's quite small. So here's how it looks like. And there's one thing I would like to point out. Do you notice that the balance sheet shows items of very aggregated amount? When I say aggregated, it means multiple accounts are combined into one single line item. So for example, if you come to the trade and other payable section here in the current liability, I think as the line item indicate trade and other payables. So it shows you a summation of all your trade and other payables. It doesn't show you the detailed breakdown. Then now the question is, what if I'm interested to see the detailed breakdown? Then the next thing I want to point out is, do you notice there's a note column here? So let's see. The trade and other payable is note 15. It means if you are interested to know in detail the trade and other payable, you can refer to note 15. Each financial statement will have its accompanying notes which will explain in greater detail what each line item comprises of. On the face of the financial statement, that means just the balance sheet here, we will want to aggregate amounts. Try not to show too much detail. So for example, let's say we are indeed interested to see what are the trade and other payables. Let's go to note number 15. So here you see notes to the financial statements. Here it is, trade and other payable. So we can see this is payable to the holding company, related company. Okay, again, don't worry what this term means. These are things that we will cover when we move on to group accounting. And outside parties, accrual, deferred income. So this is the breakdown as we know.